We see how oil in particular has been under a lot of pressure, that financial fear is bleeding into commodities. To what extent does it reflect fundamentals?
Yeah, so I mean, as you say, I mean, over the last couple of weeks, we've seen a large reduction, I guess, from speculators for their appetite for oil. And it's been largely driven by developments outside of the oil markets. I would say if we look at the fundamentals, clearly in the short term, they're not as bullish enough to offset the broader market sell-off. But if we look at the fundamentals, they really have not changed over the last 2 weeks, right? So in the short term, the oil balance looks still fairly quite comfortable, and that's due to Russian supply holding up better than expected. And so in the short term, I guess prices are likely to remain more range-bound and probably more influenced by macro factors. It's really when we go into the second half of 2023 where we see the oil market tightening quite significantly, and that should push prices higher from where we are at the moment. So for the second half of this year, we see Brent averaging $97 a barrel. And again, what's really driving that tightness? Well, firstly, it's the demand side. We see a strong demand recovery this year, particularly from China. And then that's sort of coupled with some supply constraints, right? So if we look at non-OPEC supply, we're expecting fairly limited growth there. And then OPEC Plus, well, obviously they've got their supply cuts running through until the end of this year.
Warren, you say fundamentals have not really changed, but if you listen to Citi CEO Jane Fraser, she says that the banking sector makes a recession more likely now than before. So fundamentals perhaps have changed.
Well, we'll need to see how long this lasts, right? We'll need to see let the dust settle and see what the actual impact on demand is. I think that what's important to remember is for 2023, we're looking at demand growing by about 2 million barrels a day, year on year. And the bulk of that's really going to be driven by China and its reopening, right? If we look at sort of OECD countries, so if we look at the Americas, Europe, demand growth there is a lot more modest this year, and actually still below pre-COVID levels for a lot of those regions.
Why do you think that demand picture of China, this whole kind of reopening story, hasn't quite supported oil prices up until this point, Warren? Is this recovery really still on track, you think?
Yeah, I think so. It's been a slow start, right? I mean, we obviously had Chinese New Year in January, and we also had a wave of COVID infections. So it's been a slow start to get that recovery going. But if we look at oil import data for March, it's looking as though those flows will be quite strong. It's also looking as though the tanker market's quite a bit stronger, with tankers being booked up, and apparently that's been largely driven by Chinese activity. So, you know, for the year, we are expecting Chinese demand, as I said, to grow by about 1 million barrels a day. That's going to be heavily skewed towards the second half of 2023. And so again, when you factor that strong demand growth with constrained supply, it does suggest higher prices as we move through the year.
Is oil still the best way to play that China reopening story? How are you viewing the rest of the commodities complex?
Yeah, I think probably energy is the way to go. As you say, there does seem to be a little bit of a disconnect between where oil's trading and the reopening story for China. So, I mean, we clearly see quite a bit of upside in oil prices as a result of that. If we look at metals, for example, they really rallied on the back of the reopening news, right? So I think when it comes to metals, we actually have to see fundamentals catching up with expectations if we're to see prices sort of maintaining these loftier levels that we've been seeing them trade for at least the early part of this year.